welcome to the deep dive. More and more people in India are turning to systematic investment plans, or SIPs, in mutual funds as a way to grow their wealth. It's become almost a default strategy for many.
Absolutely. That regular, drip feed approach to investing has really caught on. But even with this widespread popularity, there are still some fundamental misunderstandings about what SIPs are and maybe more importantly, what they aren't.
And that's exactly why we're here today. We've sifted through a range of perspectives, articles from places like Bajaj Finserv AMC, FinEdge, Inspira, Edelweiss MF, ClearTax, and others to sort of cut through the confusion and clarify some of these common myths.
Yeah, try and clear the air a bit.
Our goal is really to equip you with the real insight so you can make smarter investment choices. Okay, let's unpack this, starting with a really basic point. The idea that SIP is an investment product in itself.
Right, that's a big one. It's a common perception that you can just go out and buy SIP like you would, say, a particular stock or bond.
Yeah, as if SIP is the name of something tangible you add to your portfolio, like I bought 2 stocks in SIP today.
Exactly. But the reality, which, all our sources really underscore, is that SIP isn't a product, it's a method. It's a disciplined way of investing in mutual funds.
A method, okay.
Think of it less like buying a specific item and more like choosing a payment plan, maybe. Instead of one big lump sum, you're committing to invest a fixed amount regularly into a mutual fund scheme that you select.
So it's about the mechanics of your investment, how you put the money in, not the investment itself. And crucially, just starting a SIP doesn't magically guarantee returns, does it?
No, not at all. That's another key point. The returns you experience with the SIP are solely dependent on the performance of the mutual fund scheme you've actually chosen. The SIP is simply the mechanism, the tool that allows you to invest in that scheme consistently, month after month, or whatever frequency you choose. So when you're considering a SIP, the primary focus really needs to be on selecting a mutual fund that aligns with your financial goals and, importantly, your tolerance for risk.
That makes perfect sense. So when someone asks, which is the best SIP or what kind of returns can I expect from SIP, they're really asking about the underlying mutual fund, not the SIP process itself.
Precisely. Yeah, those questions kind of highlight that fundamental misunderstanding we talked about. A SIP is just the tool facilitating the regular investing.
Okay.
Now, to get a sense of potential outcomes, you might use an SIP calculator. They're useful tools. These let you project the future value based on your investment amount, the duration, and, critically, an assumed rate of return. But remember, that rate of return is tied to the fund's potential performance. It's not guaranteed by the SIP.
Right. It's an estimate based on the fund. And the actual process of setting up a CP involves linking it to a specific mutual fund. And choosing your investment frequency monthly seems most common, but quarterly, whatever works. Then the money is automatically debited and invested.
Exactly. It's all about automating that consistent investment behavior. Which brings us nicely to another common misconception, the idea that SIPs are only meant for smaller investments.
Right. You often hear about starting with just 500 or 1,000 bunts a month. So the perception is often that SIPs are just for those smaller contributions.
And while it's absolutely true that SIPs make it very accessible to start with those modest amounts, which is great, that's far from the complete picture.
Okay.
Our sources clearly state that there's actually no upper limit on the amount you can invest through a SIP.
Seriously? So someone could invest, 50,000 or maybe even a lakh or more every month through a SIP.
Absolutely. In fact, high net worth individuals, HNIs, they frequently use SIPs as a strategic way to deploy significant capital over time in a disciplined manner. It's not just for beginners.
Wow, okay.
Because the core advantage of a SIP, something called rupee cost averaging, applies regardless of the investment size.
Okay, let's dig into rupee cost averaging. That's the idea that by investing a fixed sum regularly, you end up buying more units when the market dips and fewer units when it's high.
That's the crux of it, yeah. By consistently investing the same rupee amount, you naturally buy more units when the net asset value, that's the NAV, the per unit price of the fund is lower, and you buy fewer units when the NAV is higher. Over the long term, this helps to smooth out your average purchase price. It takes some of the guesswork out of timing the market. And this principle is just as effective whether you're investing, 1,000 or 1,000 via SEP.
That's a really helpful way to frame it. It makes intuitive sense. I also came across the term step-up SIP in the research. What's that all about?
Ah, yes. Step-up FE, sometimes called the top-up FE, is a flexible variation. It lets you increase your SIP contribution amount automatically at predefined intervals, say, annually.
Oh, that's useful.
Yeah, it's particularly good if you anticipate your income growing over time. You can align your investment increases with your salary hikes, for instance. There are even specific step-up SIP calculators that can help you visualize the potential impact of these increasing contributions over time.
So SIPs aren't just for small investors. They're adaptable for investors at all stages, and you can even ramp them up.
Exactly. Very flexible.
Okay, moving on. Another myth that I found quite surprising, actually, was the belief that you can only invest in equity funds through a SIP.
Yes, this is a very prevalent misconception, and it's simply not accurate. While SIPs are indeed a very popular choice for equity investments because equities can be volatile, and averaging helps, they are equally applicable and beneficial for investing in debt funds, too.
Debt funds, really. I have to admit, I always associated SIPs primarily with the potential for higher growth in the equity markets, maybe smoothing out that volatility.
Well, think of investing in debt funds through a SIP like this. It's a more disciplined and potentially slightly more rewarding alternative to, say, a bank recurring deposit, an RD.
Okay, how so?
You're investing a fixed amount at regular intervals, just like an RD. But instead of the relatively fixed and currently often lower returns of an RD, debt funds offer the potential for somewhat higher returns. And importantly, they generally come with lower volatility compared to equity funds.
Right. So for someone with a more conservative risk profile, maybe, or shorter-term financial goals, a semi in a debt fund could actually be a viable strategy.
Precisely. Debt funds tend to offer greater stability, so they can be a suitable option for investors with a lower appetite for risk, or maybe for those saving for objectives that are just a few years down the line where you don't want too much market fluctuation. And remember, SEBI, the regulator, allows mutual funds to offer a really diverse range of both equity and debt schemes. There's a wide spectrum of choices for your SIP investments across different asset classes.
What kinds of debt funds could one consider investing in through a SI then? Are there different types?
Oh yes, there is a variety. You have things like gilt funds, which invest in government securities, duration funds that focus on different maturities, and credit risk funds that invest in lower-rated corporate bonds, each with its own distinct risk-return characteristics.
I see.
And even for these less volatile non-equity options, using a SIP still helps. It instills that financial discipline, promotes consistent savings habits, and can potentially help mitigate the urge to spend that money impulsively.
That's quite insightful. I hadn't really thought about using SIPs that way for debt funds.
Yeah.
Okay, now, let's address a concern that I think might deter many people from starting a SIP.
Yeah.
The worry that their money will be locked in, inaccessible when they might actually need it.
Yeah, that's a biggie. This is a significant concern for many investors, the idea that once you initiate a SIP, your funds are tied up indefinitely, or for a very long time.
Right.
However, for the vast majority of open-ended mutual funds, which is what most people invest in, this is simply not the case. You generally have the flexibility to withdraw your money at any point, even if your SIP itself is ongoing.
So it's not like, say, a traditional fixed deposit where breaking it early usually means penalties.
Generally, no. Now, there are some specific types of funds, like equity-linked savings schemes, ELSS. Those are the tax-saving ones. They do have a mandatory lock-in period.
Good.
In the case of ELSS, it's 3 years, and that's required to qualify for the tax benefits. But most other open-ended funds, whether equity or debt, offer considerable liquidity.
So what does that mean in practice? If I have an ongoing SIP in a regular equity fund, can I stop it? Can I take money out?
Yes. You can typically halt future SIP installments whenever you wish, usually without incurring any charges for stopping the SIP itself. And crucially, you also have the option to redeem, meaning sell the units you've already accumulated through your past SIP installments.
Okay. But are there any, hidden fees or charges associated with withdrawing the money you've already invested?
Well, there might be what's called an exit load. This is a small fee that some funds levy if you redeem your units before a specified holding period, often maybe 1 year. You need to check the fund's specific rules.
Right, check the details.
And importantly, it's crucial to remember that when you redeem your investments, any capital gains you've realized, meaning profits, will likely be subject to taxation. The tax depends on how long you held the units and the type of fund, equity, or debt.
Okay, so there are a few factors to be mindful of: potential exit loads, taxes on gains, and specific fund lock-ins like ELSS. But generally speaking, you're not locked into the SI structure itself. You can stop, make partial or full withdrawals, or even switch your SIP to a different fund within the same fund house if your investment goals change.
Exactly. That flexibility is indeed a key strength of SIs. Which brings us neatly, actually, to our next myth. The notion that SIPs themselves come with long lock-in periods.
Ah, yes. I can see how the lock-in period of certain funds, like the ELSS we just mentioned, might get confused with the lock-in on the SIP method itself.
Precisely. It's a common mix-up. But as we've clarified, SI is merely the method of investment. Lock-in periods are specific attributes of particular categories of mutual fund schemes.
Like ELSS having that 3-year lock-in.
Right. ELSS funds have that 3-year lock-in from the date of each investment, which is required for the Section 80C tax benefit.
And it's worth pointing out, isn't it, that even that 3-year lock-in for ELSS is often shorter compared to other popular tax-saving instruments.
Absolutely. Think about Public Provident Fund, PPF, that has a 15-year maturity, though partial withdrawals are possible earlier under certain conditions. National Savings Certificates, NSCs, typically have a 5-year lock-in. And 5-year tax-saving fixed deposits, well, the clue's in the name, 5 years.
So compared to those, ELSS VSIP actually offers relatively better liquidity for a tax saver.
It does. So the crucial distinction to make is that the SIP mechanism itself doesn't impose any lock-in. If you choose to invest via SIP in a fund that has a lock-in period, like ELSS, then that restriction applies to your investment. But it applies whether you invested through a DESAID or put in a lump sum. The lock-in is tied to the fund, not the SIP method.
Got it. Fund specific, not SIP specific. Okay, great. We've tackled those 5 common myths. But our sources, they provided a wealth of additional insights about SIPs. Let's maybe delve into some of those now. One point that emerged was regarding the stability of SIP investments.
Right. And again, it comes back to the underlying fund. The stability, or lack thereof, isn't an inherent feature of the SIP method itself. It's entirely determined by the type of mutual fund you select for your SIP.
So equity funds are still volatile, even with a SIP.
Exactly. Equity funds, as we know, carry market risk and are subject to fluctuations. Debt funds generally exhibit lower volatility. Investing through SIP in either type of fund doesn't fundamentally alter that underlying risk profile of the asset class. The SIP just changes how you invest in it over time.
Makes sense. And how do SIPs generally compare to, say, traditional fixed deposits, FDs? That's a comparison people often make.
Yeah, it's a common question. Equity SIPs over the long term offer the potential for higher returns compared to FDs. And this is but they also come with a higher degree of risk.
Right. Higher potential reward, higher risk.
Correct. Debt SIPs, on the other hand, might provide returns that are comparable to or perhaps slightly better than FSDs, but generally with less risk than equities. Though still not risk-free, of course.
So the choice really depends on the individual.
Absolutely. The optimal choice truly hinges on your individual risk tolerance, your specific financial objectives, and the time horizon you have for your investments. There's no single better option. It's about what's right for you.
Okay. What were some of the key benefits of using SIPs that our sources consistently highlighted?
Well, the recurring advantages that kept coming up were, first, rupee cost averaging, which we discussed. Second, the disciplined investment habit it fosters, taking the emotion out of it. Third, the power of compounding over the long term, which is huge. Fourth, the flexibility starting with smaller amounts, the step-up option, the general liquidity we talked about. And finally, the wide accessibility of SIPs across almost all mutual fund categories.
It certainly seems like SIPs have gained significant traction in India. Did our sources offer any data illustrating this growth?
Oh, absolutely. The data, particularly from AMFI, the Association of Mutual Funds in India, reveals a really remarkable surge in SIP accounts and the total amount of money being invested through them in recent years.
Like what kind of numbers are we talking?
Well, the total number of outstanding SIP accounts has seen a dramatic increase, crossing, I believe, 8.7 crore recently. And the total assets managed through SIPs, the SIP AUM, has more than doubled in just a couple of years, reaching over 11 lakh crore.
Wow.
And perhaps most tellingly, the monthly SIP contribution figure keeps hitting new highs. It reached a record level in May 2024, surpassing 20,900 crores in a single month.
20,000 crores a month. That's impressive growth. It really underscores the growing confidence and adoption of this investment approach, doesn't it?
It absolutely does. People are embracing that systematic approach.
Okay, so the money is flowing in. What about the actual returns that investors have been realizing over time? Any examples?
Yes, one of our sources provided a compelling example. They looked at a large cap fund tracking a consistent monthly SIP of 10,000 over a decade, from 2014 to 2024.
Okay, 10,000 a month for 10 years.
Right. The total investment over that period would be 12 lakhs. The analysis showed that this generated an XIR, that's the effective annualized rate of return, accounting for the timing of cash flows, of over 14%.
14% annualized.
Yes, and this transformed that total investment of 12 lakhs into a corpus of over 25 lakhs.
That's more than double the investment.
It is. And while they noted that mid-cap and small-cap funds have at times delivered even higher XIR returns over similar periods, it's crucial to remember they typically come with significantly greater volatility and potentially lower liquidity. So risk-reward trade-off again.
So SIPs aren't just about smoothing volatility, but they can really contribute to significant long-term wealth accumulation, especially with compounding.
Precisely. SIPs play a vital role in achieving long-term financial goals like, say, retirement planning or funding children's education. And that benefit of rupee cost averaging is particularly valuable during periods of market volatility.
How so? Because you're buying cheaper.
Exactly. Even when markets experience downturns, and they inevitably do continuing, your SIP allows you to accumulate more units at a lower NAV. This can significantly enhance your overall returns when the market eventually recovers.
So sticking with it during the dips is key.
Absolutely critical. We saw examples looking at various market corrections between 2014 and 2024, periods of significant drops. The subsequent market rebounds really rewarded those investors who maintained their SIP discipline throughout.
It sounds like SIPs also have a broader positive impact, not just for individual investors, but maybe for the mutual fund industry itself.
They do in a couple of ways. Firstly, as we've said, SIPs encourage financial discipline among investors, which leads to more consistent portfolio growth rather than erratic lump sum entries and exits. Secondly, these steady and more predictable inflows from millions of SIP accounts provide mutual fund managers with a more stable pool of capital. This allows them to plan their investment strategies more effectively, potentially reduce transaction costs associated with managing sudden large inflows or outflows, and take a longer-term view.
Ah, I see. So it helps them manage the fund better.
Yes. You know, the introduction of SIPs in India back in the early 2000s was truly transformative. It helped address some of the challenges associated with purely lump sum investing, like market timing anxiety, and it fostered a much more disciplined investment culture nationwide.
Interesting. Our sources also briefly touched upon the distinction between direct and regular mutual funds. How do SIPs fit into this picture? Can you do SIs in both?
Yes, absolutely. You can implement a SIP strategy in both direct plans and regular plans of mutual funds. The primary difference between them lies in the expense ratio, the annual fee charged by the fund.
Right, direct is usually cheaper.
Typically, yes. Direct funds, where you invest directly with the fund house without an intermediary, generally have a lower expense ratio because they don't include distributor commissions. Regular funds, usually purchased through an advisor or distributor, have a slightly higher expense ratio that incorporates that commission.
So this SIP mechanism works the same, it's just the underlying fund plan and its cost structure that differs.
Exactly. Your choice between direct and regular plans for your SIPs might depend on whether you prefer to manage your investments independently and save on costs, or if you value and are willing to pay for professional guidance from an advisor.
Okay. Now, are there any potential downsides or risks associated with SIPs that we should be aware of? It sounds mostly positive.
Well, while SIPs are generally beneficial, one concern raised in the sources is the possibility of investors becoming overly reliant on them, maybe adopting a set-it-and-forget-it mentality to an extreme.
Meaning they don't review their investments.
Potentially, yes. It's crucial to remember that a SIP is a valuable tool, but it doesn't replace the need for periodic portfolio review. You still need to occasionally check if your chosen funds are performing adequately, and if they continue to align with your evolving financial goals and risk profile. Things change over time.
Good point. Don't just automate and ignore.
Right. And another point is about investor behavior. Investors should be conscious of their own behavioral biases. The big one is the urge to panic and halt their SIs during market downturns. Doing that undermines the very benefit of rupee cost averaging you're trying to achieve.
So discipline cuts both ways, starting it and sticking with it.
Exactly. Consistency is key.
Our sources also included some interesting comparisons between SIPs and lump sum investments, particularly looking at risk and return. What were the key insights from that analysis?
Yeah, there was a study from Inspira, I believe, that specifically compared the risk and return characteristics of both SIP and lump sum investments across different fund categories: equity, hybrid, ELSS.
What did it find? Is one better?
Well, better depends on your perspective. The study highlighted that while lump sum investing can potentially yield higher returns if you time the market perfectly, which is very difficult, it also exposes you to much greater risk because your entire capital is subject to market movements immediately.
Right. All your eggs in one basket, timing-wise.
Kind of. SIPs, on the other hand, with their inherent rupee cost averaging, tend to offer better risk management. By spreading your investment over time, you mitigate the impact of market volatility. You're less likely to invest everything right at a market peak.
So SIPs are generally less risky in that sense.
The study analyzed various risk-adjusted return metrics, things like Sharpe ratio, standard deviation, beta for large-cap funds, and generally found that the SIP approach provided a more stable and less volatile investment journey.
Okay. What about actual returns?
Comparative three-year returns showed that while lump sum returns could be higher in certain specific periods if the market went straight up after investing, SIP returns often remained competitive and were generally achieved with less volatility.
So the conclusion was?
The overarching conclusion seemed to be that while lump sum investing has the potential for higher gains but carries greater risk and timing challenges, SIPs offer a disciplined, convenient, and generally more risk-mitigating approach, primarily thanks to that rupee cost averaging effect.
That makes a lot of sense. Now, the power of compounding is often highlighted in discussions about SIPs. Can you maybe break down how that works in this context?
Absolutely. Compounding is, well, it's often called the eighth wonder of the world for a reason. It's essentially earning returns not just on your initial investment, your principal, but also on the accumulated interest or earnings from previous periods. It's returns earning returns.
Okay. And how does that apply specifically to SIPs?
In a SIP, you're regularly adding new money, and the returns generated by your total accumulated investment are reinvested back into the fund. Over time, this creates a snowball effect. Your investment base grows not just from your contributions, but also from the earnings it generates, leading to potentially exponential growth, especially over the long haul.
So even small amounts can grow significantly.
Exactly. Even relatively small, regular SIP investments can snowball into a surprisingly large corpus over many years, purely due to this compounding effect. The key factors are giving it enough time, a long investment horizon, and starting as early as possible.
Time is crucial.
Absolutely. For instance, one source highlighted the difference in potential wealth accumulation between someone starting a SIP at age 25 versus someone starting the same SIP at age 35. Even with the same monthly contribution and assumed return rate, the person who started 10 years earlier ends up with a substantially larger amount at retirement, purely because their money had more time to compound.
Oh. Can you give a quick example with numbers?
Sure. Let's take a hypothetical monthly SIP of $5,000, assuming an average annual return of, say, 12%, which is illustrative, not guaranteed, of course.
Yeah.
After 5 years, your total investment is 3 lakhs. It might grow to around 4.1 lakhs. After 10 years, you've invested euro 6 lakhs, and it could potentially grow to about 11.6 lakhs.
Quite a jump.
But look at 20 years. You've invested 12 lakhs in total. Thanks to compounding, that could potentially grow to almost 50 lakhs.
50 lakhs from 12 invested. That really shows the power over time.
It really does. Compounding is a long-term game.
SIP calculators sound like they'd be really helpful for visualizing this kind of growth.
They absolutely are. An SIP calculator is a fantastic tool. It allows you to estimate the potential future value of your SIP investments based on 3 main inputs: the regular investment amount, the investment period, how long you plan to invest, and the expected or assumed rate of return.
So you plug in your numbers and it projects forward.
Exactly. It typically uses a standard future value formula to project these potential returns. It's incredibly useful for financial planning. It lets you compare different scenarios, like what if I invest $5,000 versus $10,000 a month, or what's the difference between 10% and 12% expected return, and helps you set realistic targets for your financial goals, like retirement or buying a house.
And it can show the compounding effect year by year.
Good ones do, yes. They can illustrate the year-by-year growth, showing how the earnings portion starts small but becomes increasingly significant over time, really highlighting that compounding magic.
Useful indeed.
Yeah.
Now, are there different types of SIPs that investors should be aware of? Is it just one standard thing?
No, there's actually a bit of variety beyond the standard regular SI where you invest a fixed amount each month.
Oh, Like what?
Well, we mentioned the top-up or step-up SIP, where you can periodically increase your investment amount automatically. There are also flexible ASIR, which offer the option to modify the installment amount or even skip an installment based on your cash flow needs or market views, though these are less common.
Okay.
You might also hear about perpetual SIs, which don't have a specified end date. They continue until you actively stop them. Trigger SIPs are more advanced. They might activate or change based on predefined market events or index levels. Then there are goal-based SIs, where you specifically link an SIP to achieving a particular financial objective, like a retirement goal. And multi-SIPs allow you to invest in multiple mutual fund schemes within the same fund house through a single SIP mandate, simplifying things a bit.
So quite a few flavors to choose from depending on your needs.
Yes, understanding these different types can certainly help investors tailor their strategy more effectively.
Makes sense. Our sources also pointed out some common mistakes to avoid when investing through SIPs. What are some of the most frequent pitfalls people fall into?
Ah, yes. Avoiding mistakes is just as important as getting the strategy right. Several common pitfalls can really hinder the effectiveness of your SIP investments.
Such as?
Well, number one is probably starting too late, delaying your investments and losing out on valuable compounding time. Another big one is neglecting to do thorough research, due diligence, before selecting a mutual fund. Just picking a random fund because it sounds good isn't a strategy.
Right. Choose the fund wisely.
Absolutely. Investing without clear financial goals in mind is another mistake. Why are you investing? What are you aiming for? Not budgeting adequately for your SIP contributions can lead to stopping them prematurely if finances get tight. And as we discussed, stopping your SIPs during market downturns is a classic error panic. Selling or pausing defeats the purpose of averaging down. Failing to review your portfolio periodically is another.
The set and forget trap again.
Exactly. Focusing only on short-term returns instead of the long-term goal can lead to bad decisions. Ignoring important details like the exit load and the expense ratio of the funds you're investing in, those costs add up. And finally, withdrawing your investments prematurely before allowing the power of compounding to really work its magic over many years.
So lots of potential behavioral traps and oversight issues to watch out for.
Definitely. Avoiding these common errors can significantly enhance your SIP investment outcomes over the long run.
Okay. Finally, one of our sources, Incred Premier, discussed the advantages of a staggered investment approach, particularly during times of market volatility, like around the recent elections. Can you touch on that?
Yes, that was an interesting analysis. They looked specifically at the market conditions surrounding the Indian general elections in April-June 2024. As you know, the market experienced some volatility and corrections following the election results.
Right, there was a dip.
Exactly. They illustrated how a staggered investment strategy during such a period could be beneficial. For instance, instead of putting a large lump sum in all at once before or after the event, they suggested considering investing a portion of your capital during market dips and then spreading the remainder through SIPs over the next few subsequent months.
Sort of combining lump sum timing with SIP discipline.
Kind of, yeah. Deploying capital strategically over time rather than all at once. They showed an example where this staggered approach potentially yielded better risk-adjusted returns, a higher XIR, compared to just putting all the money in on one day during that volatile period.
Interesting. And did they have a longer-term view on SIPs versus lump sum?
They also highlighted that over the preceding 5 years, consistent monthly SIPs in the Nifty Y50 index had actually outperformed the overall point-to-point CGR returns of the index itself.
Meaning the regular investing beat just buying and holding from the start date.
In their specific example, yes, demonstrating the effectiveness of that disciplined SIP approach for long-term wealth creation, even in major indices. Their practical recommendation for navigating current market conditions, given the volatility, involved considering investing maybe around 50% of your available corpus during significant market corrections, and then systematically investing the remaining 50% through SIPs over the next, say, 3 to 6 months.
So a blend of opportunistic buying and disciplined averaging.
That seems to be the suggestion, yes. A pragmatic approach to navigate uncertainty.
Okay, so wrapping this all up, the key takeaway from our deep dive today seems to be that SIPs are a really powerful and versatile tool for building wealth systematically over time. But, like any tool, understanding their nuances, how they actually work, and avoiding those common pitfalls is absolutely essential for maximizing their potential.
Absolutely. I think by dispelling these common myths that SIPs are a product only for small amounts, only for equity, have lock-ins, etc., and gaining a deeper understanding of how they function, especially rupee cost averaging and compounding, you, the listener, can empower yourself to make much more informed investment decisions.
Right. And hopefully work towards achieving your long-term financial goals with, a bit more confidence and clarity.
That's the goal.
So for you listening, maybe take a moment to really consider how the power of compounding, combined with a disciplined, systematic investment approach like SIPs, could contribute to your long-term financial well-being. It's definitely worth exploring further, perhaps using some of those calculators, and thinking about how to craft a strategy that aligns perfectly with your individual goals and your comfort level with risk. Thanks for joining us on this deep dive.